I have over $4,000 invested in Amazon stock. The market is currently panicking about Amazon's $200 billion AI bet, but I think the fear around Amazon spending has created an opportunity for investors to buy the stock on sale. First, I'm going to tell you why Amazon stock is struggling to keep up with the rest of the market. In February 2026, Amazon announced it plans to spend $200 billion this year, meaning the company's free cash flow would turn negative, coming in at minus $17 billion, according to analysts at Morgan Stanley. And in a filing with the SEC, Amazon notified investors that it may seek to raise equity and debt to finance its AI spending. This is part of a broader trend, with the AI hyperscalers Alphabet, Amazon, Meta, and Microsoft spending up to $700 billion this year alone to fuel their AI data centers. Alphabet, the parent company of Google and YouTube, just raised $80 billion from the public markets by selling more shares. Even Nvidia, the company selling AI GPUs to the hyperscalers, is set to raise around $20 billion in debt. This activity spooks investors because it increases uncertainty in the short term. Strong companies like Amazon spending hundreds of billions of dollars and even borrowing money to make risky AI investments with an unknown return. But is this really the case? Are these AI investments actually that risky? I think not, and I'm going to give you the 3 reasons why I'm bullish on Amazon stock. So the first reason why I'm bullish on Amazon is because I think their AI spending will actually benefit the company long term. In their recent earnings call, Amazon's management team said they expect substantial ongoing Capex for chips, data centers, and networking to meet AI and core cloud demand. Capex is just another term for investments the company is making in its own business infrastructure. They say Capex is typically incurred 6 to 24 months before monetization, and those assets have long useful lives. Data centers typically last 30 years or more, and chips, servers, and networking last around 5 to 6 years. This is a very important point, and why I believe the market is wrong to judge the hyperscalers this early. Amazon is basically saying that they're spending $200 billion in 2026, but those new assets won't produce any revenue until 2028 or 2029. Amazon say high growth phases like the current AI wave pressure near-term free cash flow, but historically have led to attractive longer-term free cash flow and ROIC, as in the first AWS growth cycle. And this is completely true. As you can see from this chart of Amazon's free cash flow, they go through waves of heavy investment cycles, and then 2 to 3 years later, their free cash flow explodes. It's hard to tell exactly where we are in the current cycle, but with free cash flow recently turning negative on a trailing 12-month basis and the company potentially raising money by selling new shares, we're likely 2 to 3 years away from Amazon's free cash flow hitting new all-time highs. Amazon say memory and storage costs, especially for high-end memory, have skyrocketed. Amazon secured significant supply by working early and closely with suppliers. HBM, or high bandwidth memory, made by companies like Micron, have become an important component in the AI stack, leading Micron's profits to explode, up 400% in the past year, while the company's stock price is up over 800%. Micron are one of only 3 main global suppliers of memory chips, and once demand skyrockets, they have to invest in new factories. These new factories take at least 2 to 3 years before they become operational. Until the supply of chips are increased, prices will remain a major bottleneck in the AI build-out. But the bright side is that many enterprises are choosing to migrate to Amazon's cloud services for this exact reason. Amazon say tight component supply is accelerating some on-premise enterprises' migration to AWS, as large cloud providers are prioritized for scarce components. What Amazon is basically saying here is that enterprises can't access a new memory supply while the hyperscalers gobble it up, so they're choosing to migrate instead, meaning more customers for AWS. Speaking of AWS, the second reason why I'm so bullish about Amazon is their cloud computing business. AWS, or Amazon Web Services, is becoming an increasingly large and profitable part of Amazon. In the last 12 months, AWS produced $137 billion of Amazon's $742 billion revenue, and this revenue is highly profitable, with operating margins of around 35 to 40%, meaning AWS made up roughly 50% of Amazon's net income for the last 12 months. And because AWS is the fastest growing part of Amazon, with revenue up 28% last quarter, the company's overall operating margin will continue to expand. We can see from this chart that Amazon's operating margin expanded from 4% back in 2016 to over 13% in Q1 2026. This means that as AWS becomes a larger part of Amazon's overall business, their profits will grow faster than revenue. In their recent earnings, Amazon said AWS revenue was $37.6 billion, up 28% year over year, the fastest growth in 15 quarters. AWS now runs at a $150 billion annualized revenue rate. So not only is AWS Amazon's fastest growing business segment, its growth rate is increasing. AI is driving both AI-specific and core cloud usage. AI revenue is growing triple digits year over year. This is something I don't think the market is quite understanding. The use of AI not only creates new revenue streams, but also increases the need for cloud storage. Early adopters, AI labs, are spending very heavily on compute, but enterprise AI usage is also ramping across cost savings and new experience projects. AWS backlog is $364 billion in Q1, excluding a recently announced $100 billion Anthropic deal, with broad customer participation beyond just the largest labs. This chart shows the AWS backlog. These are customer contracts signed for access to future cloud services. The rate of growth in the AWS backlog is insane. It grew 92% in the past year, and that's without the recently announced Anthropic deal, adding another $100 billion in future commitments. Management sees the current AI cycle as a once-in-a-lifetime opportunity, expecting every major application and customer experience to be reinvented with AI. The third reason why I'm bullish about Amazon is the growth in their advertising business. This chart shows the advertising revenue of the three largest players: Amazon in orange, Alphabet in red, and Meta in blue. You can see that Alphabet and Meta are basically neck and neck, while Amazon is a much smaller but still significant player. Amazon ads generated $17.2 billion in Q1 revenue, up 22% year over year. Forrester named Amazon a leader in omni-channel advertising platforms, highlighting connected TV and commerce media capabilities. The Netflix partnership deepened via Amazon Audiences, using Amazon's commerce and browsing signals to better target Netflix viewers. The Netflix partnership might partly explain why Netflix's advertising revenue is set to double again this year to $3 billion. And like AWS, advertising is incredibly important for the company's operating margins. Amazon have never officially commented, but market analysts believe Amazon's advertising operating margins are between 40 and 50%. So if Amazon can maintain annual advertising growth between 15 and 20%, it will significantly boost their net income. Now we're going to look at the current valuation of Amazon stock. On a price to earnings basis, Amazon currently trades at a 29 trailing PE. Amazon's forward PE ratio also trades at 29. If you adjust for Amazon's projected earnings in 2027, the PE multiple falls to 24. At first glance, Amazon definitely doesn't look overvalued based on the PE multiple. If we look at this chart of Amazon's price to earnings multiple over the last 2 years, you can see that the multiple has slowly declined over time. This is mostly because their earnings per share have grown substantially through operational strength and cost discipline, and the market now views Amazon as a mature growth company. Next, I'm going to run you through my base, bear, and bull case assumptions for Amazon stock. Using Qualtrim's DCF calculator, we can project the expected return from Amazon stock over the next 5 years. First, we have my base case assumptions, which include 20% earnings per share growth and a 30 PE multiple. I think 20% annual growth in Amazon's earnings per share is very reasonable. In the last 5 years, Amazon's EPS grew an annualized rate of 26%, and as their high margin AWS and advertising revenue segments outpace the growth of their e-commerce platform, operating margins will continue to expand over time. That fact alone should boost EPS substantially long term. So in my base case scenario, Amazon stock would increase from $240 to $620 per share in the next 5 years. That's a 20% annual return, meaning Amazon stock would more than double. Then in my bear case scenario, I'm projecting 15% earnings per share growth and a 25 PE multiple. In this scenario, Amazon stock would increase from $240 to $420 per share in 5 years. That's an 11% annual return, which isn't bad, but as an Amazon investor, I'm hoping for significantly better returns than that. So for my bull case assumptions, I've gone with 25% earnings per share growth and a 30 PE multiple. In this scenario, Amazon stock would increase from $240 to $760 per share in 5 years. That's a massive 25% annual return from today's price, meaning the stock would more than 3x in value. And I don't even think these assumptions are that unreasonable. So what am I planning to do with my Amazon position? The stock currently makes up about 14% of my portfolio. As much as I'd love to add to the position, it's already pretty big. But if I did deposit any new cash into the portfolio, Amazon will be high up on my list of potential buys.